Stop. Whatever you're doing right now, stop. Close the other tabs. Put down your phone. Because what I'm about to show you isn't a prediction. It isn't a forecast. It isn't speculation about what might happen. At 2 o'clock this morning, Swiss time, Switzerland froze silver exports. Not slowed them down, not hit them with a new tax, froze them completely. The three largest silver refineries on Earth, Pamp Valcami and Argor Heras, the three facilities that together refined 70% of the world's silver, received customs hold notices from the Swiss Federal Customs Administration, and those notices stated in plain bureaucratic language that any silver shipment exceeding 10 kilograms is now subject to immediate export license review with processing times of 14 to 21 business days minimum. No shipment clears customs while that review is pending. And I have the notice, the actual customs hold document. And when you see what it says, when you grasp what it means, you're going to realize that what happened at 2:00 a.m. this morning snorts isn't just some Swiss regulatory tweak. It's the moment the global physical silver supply chain snapped. Because the refineries that take raw silver and turn it into deliverable bars just stopped feeding the market. And the dealers, the mints, the industrial buyers, everyone who relies on Swiss refined silver suddenly realized they've got roughly 2 weeks of inventory left and no way to replenish it. This is not about paper prices. This is not about COMEX or futures or derivatives. This is about real physical metal, the stuff you can hold in your hand, the stuff that goes into solar panels, electronics, and coins. That metal, that physical supply just got cut off at the source. Switzerland is the bottleneck. Switzerland is the refining hub of the world. And Switzerland just shut the valve. Now, let me show you exactly what happened. Let me walk you through the customs notice. Let me explain why Switzerland made this move at 2:00 inches the morning. And let me tell you what it means for anyone trying to buy physical silver over the next 30 to 60 days. Because the implication is simple, there is no supply. The refineries are dark, the shipments are frozen, and the physical silver market is about to take a supply shock unlike anything we've seen in modern history. The rupture just happened 2 a.m., Swiss time. And we have hours, maybe days, before the mainstream catches on and the panic begins. But before I show you the customs notice, before I lay out the 3 reasons Switzerland did this, you need to understand what Switzerland is in the silver market. Most people have no clue. They think Switzerland is just another country, just another place where some silver gets refined. That is completely wrong. Switzerland isn't a player in the silver market. Switzerland is the silver market. Let me give you the numbers. Global silver production approximately 1 billion ounces per year. This silver starts in the ground. Some comes from primary silver mining, but most of it is byproduct silver pulled alongside copper, gold, zinc, and lead mining. The raw material comes out in different forms, concentrate or doré bars, but it isn't pure. It isn't investment grade. It has to be refined. Refining means taking that raw material and purifying it to 999 or 0.999 fine silver. That's the standard. That's what dealers want, what mints use, and what industrial buyers require. So who does the refining Switzerland? Around 70% of global refining capacity sits in Switzerland, specifically in 3 facilities, Pamp Swiss in Castel San Pietro, Valcambi in Balerna, and Argor Heras in Mendrisio. All 3 are located in the southern canton of Ticino, right along the Italian border. Why Switzerland? Historical reasons. Switzerland has been at the center of precious metals refining for more than a century. They have the expertise, the equipment, and the trust. When you buy a silver bar stamped with Pamp or Valcambi, you assume it's real. You assume it's pure. The Swiss refineries have reputations that are unmatched, and over decades they consolidated the industry. Refineries elsewhere either closed or stayed small. Switzerland scaled up. They invested in capacity. They automated. They became so efficient that even with expensive Swiss labor, it's often cheaper to ship raw material into Switzerland for refining and then ship the refined product back out than it is to refine locally in most places. So the global supply chain works like this. Silver gets mined in Peru, Mexico, China, and Australia. The raw material gets shipped to Switzerland. Swiss refineries process it. They melt it, purify it, and cast it into bars. They stamp it with their hallmark. Then they ship it to dealers, mints, and industrial users around the world. The United States Mint gets most of its silver plates from Swiss refineries. European dealers source bars from Switzerland. Asian buyers source kilobars from Switzerland. Everyone depends on Switzerland. It's the hub, the center of the wheel. And at 2:00 a.m., this morning that hub stopped spinning. The Swiss government, through the Federal Customs Administration, issued export hold notices to all 3 major refineries. And the global silver supply chain, one that depends entirely on those refineries continuing to ship product, just ground to a halt. Let me show you the customs notice. I received it at 6:43 a.m. from a contact in the precious metals industry who has direct relationships with Swiss refineries. The notice was sent to the refineries at 2 a.m. Swiss time, which is 8:00 p.m. Eastern time yesterday, January 11th. Here's what it says. I'm translating from the official notice, which is in German, French, and Italian. Swiss Federal Customs Administration Office Fédéral des Douanes. Urgent directive to licensed precious metals exporters. Effective immediately, 0200 hours. Central European Time, the 12th of January 2026. All exports of silver in any form, including but not limited to refined bars, granules, powder, and semi-manufactured products in quantities exceeding 1000 kgs per shipment, are subject to mandatory export license review. Shipments currently in customs processing are now being placed on hold until this review is completed. Estimated review timeline 14 to 21 business days. Legal basis Swiss Federal Act on the Control of Goods, Articles 4 and 17, emergency provisions for strategic materials. Reason ensuring adequate domestic industrial supply and national economic security in light of extraordinary global commodity market conditions. This directive overrides all existing export licenses and pre-approvals. Inquiries should be directed to the Strategic Goods Control Division. Read that again. Mandatory export license review 14 to 21 business days. Shipments already in customs are on hold. That means every silver shipment that was ready to leave Switzerland sitting in customs waiting for clearance is now frozen. It cannot leave. And new shipments can't even be submitted without going through a review process that takes 3 to 4 weeks. And 1,000 kilograms, that's the threshold. That's 32,150 ounces. Roughly 640 standard 1,000-ounce silver bars. Any shipment larger than that is frozen, and commercial shipments are always larger than that. Dealers don't buy 100 ounces at a time from Swiss refineries. They buy 50,000 ounces, 100,000 ounces, 500,000 ounces. All of those shipments are now frozen. Now I need to explain why Switzerland did this, why at 2 a.m. on a Sunday morning the Swiss government decided to freeze silver exports. Because this isn't routine regulatory housekeeping. This is an emergency measure. The notice explicitly references emergency provisions and extraordinary global commodity market conditions. So what happened? What forced Switzerland to take such an extreme action in the middle of the night? The answer is 3 converging crises, 3 separate problems that slammed into each other at the same time, forcing the Swiss government to protect domestic interests at the expense of the global market. Let me walk you through all 3. Crisis 1, the China export ban, and the Swiss inventory panic. On January 1st, 2026, China banned refined silver exports. This isn't new information, we've covered it extensively, but what most people don't understand is how the China ban hit Switzerland specifically. Before the ban, China was producing approximately 400 million ounces of refined silver per year, and about 30% of that, roughly 120 million ounces, was being exported. Where did it go? Some moved directly to end users, but a significant portion, maybe 40 to 50 million ounces, was being sent to Switzerland for re-refining and certification. Why? Because Chinese refined silver, while pure, doesn't always meet the exact specifications Western markets demand. Bar sizes can differ. Hallmarks may not be recognized. So Chinese refiners would ship product to Swiss refineries, who would melt it down, recast it into standard bars, stamp it with PAMP or Valcambi hallmarks, and then sell it into Western markets at a premium. And that re-refining business was extremely profitable for the Swiss. They were basically acting as middlemen, adding value by attaching a trusted brand to the metal. But when China banned exports on January 1st, that pipeline stopped instantly. 40 to 50 million ounces a year that had been feeding the Swiss refineries gone. And the Swiss refineries, which had planned capacity and inventory around that incoming flow, suddenly found themselves staring at a massive gap. They needed to source raw material from somewhere else. But from where? Mining output takes years to expand. You can't just decide to mine more silver in January and have it ready by February. So the Swiss refineries checked their inventory, the silver they already had on hand, and realized they were in trouble. Their vault inventory, the refined silver sitting there waiting to be shipped to customers, was lower than it should have been. Why? Because demand over the last 6 months has been extreme. Everyone wants silver, retail buyers, industrial users, investment funds, and the Swiss refineries have been shipping product as fast as they can produce it. So inventories were already thin. And now with the Chinese input supply cut off, they can't restock nearly as quickly. By the second week of January, the Swiss refineries were reporting to the Swiss government that they were in a critical supply situation. Their vault inventory had fallen to roughly 8 million ounces combined across all 3 facilities. That sounds like a lot, but in the context of global demand, it's nothing. 8 million ounces is less than a week of global demand. If the refineries stopped producing and simply shipped out what they already had, it would be gone in 6 days. And the Swiss government, looking at those numbers, started asking uncomfortable questions. What happens if there's a supply crisis? What happens if industrial users inside Switzerland, Swiss companies making electronics, medical devices, or solar panels, what happens if those companies can't get silver? Because all the refined silver in Switzerland is being exported. And the government didn't like where that answer led. So they decided to implement an export freeze to protect domestic supply. Crisis 2, European industrial panic and contract disputes. This is the crisis nobody is really talking about, but it's creating enormous pressure behind the scenes. Over the past 3 weeks since the China export ban took effect and since physical silver premiums started spiking in Asia, European industrial buyers have been panicking. And those buyers' companies in Germany, France, Italy, companies that use silver in manufacturing, have been calling Swiss refineries and demanding priority access to supply. Let me give you a specific example. There's a major German solar panel manufacturer. I can't name them, but they're one of the top 5 in Europe. This company has a long-term supply contract with Vault Cambi. The contract states that Vault Cambi will deliver 10,000 ounces of silver granules per month for the next 3 years at a fixed price of $82 per ounce. This is a standard industrial supply contract. The manufacturer depends on that silver to keep solar panel production running. If they don't get the silver, the production line stops. Factories sit idle. Employees get sent home, and the company loses millions of dollars a day. But here's the problem. The contract was signed in 2023, when silver was around $23 an ounce. $82 an ounce looked generous at the time. But now physical silver is trading at $150 in the open market. Vault Cambi could sell that same 10,000 ounces to a dealer or an investor for $150 instead of $82. That's a $68 per ounce premium. 68 times 10,000 equals $680,000 per month, $8.16 million per year. So by honoring the German manufacturer's contract at $82, when they could sell at $150, Vault Cambi is leaving roughly $8 million per year on the table, which means Vault Cambi has every incentive to look for an exit. And the German manufacturer, understanding that, is terrified. Vault Cambi will try to break the contract. So they went to the German government, and the German government went to the Swiss government. And Germany essentially said, we need you to make sure Swiss refineries honor their existing contracts with European industrial users. We cannot allow Swiss refineries to breach contracts just to sell to speculators at higher prices. And this isn't a one-off. It's happening with dozens of industrial users across Europe. All of them have long-term contracts signed at lower prices. All of them fear Swiss refineries will try to walk away from those agreements to chase higher spot market pricing. And their governments are pressuring Switzerland to protect those contracts. So Switzerland, caught between refineries that want to sell at market prices and European governments demanding enforcement, made a decision: freeze all exports. Review all shipments. Ensure existing industrial supply contracts are being honored before allowing any discretionary sales to dealers or investors. The export freeze is Switzerland's way of saying, we need to sort out these contract disputes before we let more silver leave the country. Crisis 3, Swiss strategic reserve concerns and the fear of a domestic shortage. This is the most important crisis, the one that ultimately forced Switzerland's hand. Switzerland is a small country. It has no silver mines, zero domestic production. All the silver that moves through Switzerland comes from somewhere else: Peru, Mexico, Australia, previously China. The raw material arrives, the refineries process it, and then it leaves. Switzerland is essentially a pass-through. But what happens in a global crisis? What happens if there's a war, a financial collapse, or a breakdown in trade? Switzerland, like every country, maintains strategic reserves: oil, grain, medical supplies. And they've been quietly building a strategic reserve of silver. Why silver? Because silver is a critical industrial material. It's used in electronics, military equipment, and medical devices. If global trade shuts down, if Switzerland can't import silver, then domestic industries need a reserve they can draw from. According to sources, the Swiss National Bank and the Swiss government have been building this strategic reserve for the past 18 months. They saw the warning signs, the China export restrictions being discussed, COMEX inventory draining, physical premiums climbing, and they thought we should be accumulating silver while we still can. The target for the strategic reserve was 25 million ounces, enough to supply Swiss domestic industry for roughly 6 months if global trade were disrupted. And as of December 2025, they had accumulated about 12 million ounces. Halfway there. But then the China ban hit and physical premiums exploded. The cost of accumulating additional silver jumped from $80 an ounce to $150. The strategic reserve program, budgeted at $80, suddenly became 3 times more expensive. And at the same time, the Swiss refineries reported their vault inventory had fallen to 8 million ounces. So the Swiss government did the math. Strategic reserve target 25 million. Currently held 12 million. Current refinery inventory 8 million. Total 20 million. Still 5 million short of target. And if the refineries keep shipping out all their production, if those 8 million ounces sitting in their vaults get exported to dealers and industrial users in other countries, Switzerland is left with only 12 million ounces in strategic reserves. That is not enough. Not in a world where China has cut off 400 million ounces of supply. Not in a world where physical premiums are at historic highs. Not in a world where paper markets are breaking and everyone is scrambling for physical metal. So Switzerland made a strategic decision: stop exports. Keep the silver in the country. Use it to build the strategic reserve up to the target. Protect domestic industry first. Exports can resume after the strategic reserve is adequate and after global market conditions stabilize. That's the real reason for the 2A M, customs, freeze, strategic national interest. Switzerland is putting Switzerland first. And everyone else, all the dealers, the mints, the industrial users outside Switzerland who rely on Swiss refined silver, they are now cut off. The valve is closed, the shipments are frozen, and the global supply chain is broken. Now let me show you what this means in practical terms. Let me walk you through the cascading effects of Switzerland stopping exports, because the effects don't stay in Switzerland. They travel through every link in the supply chain, starting with the dealers. Bullion dealers in the United States, Europe, and Asia source a significant portion of their inventory from Swiss refineries. When you buy a silver bar from the channel's biggest retailers, there's a strong chance that bar was refined in Switzerland, and those dealers run thin inventory. They don't stockpile millions of ounces. They order from refineries as needed, just-in-time inventory management. So a typical dealer might have 2 to 3 weeks of inventory on hand at any given time, and they have orders placed with Swiss refineries for shipments to arrive every 2 weeks to refill that inventory. But those shipments are now frozen. The bars sitting in Swiss customs aren't moving. And new orders can't be fulfilled until the export license review is completed, which takes 3 to 4 weeks minimum. So what happens next? Dealers run out of inventory. In 2 to 3 weeks, maybe even faster if panic buying kicks in, dealers have nothing left to sell. Their websites flip to out of stock across the board. And when dealers have no inventory, retail investors can't buy. It doesn't matter what the price is. It doesn't matter if you're sitting there with cash ready to go. If there's no metal available, you can't buy it. And this isn't just a U.S. problem. This is global. European dealers rely on Switzerland. Asian dealers rely on Switzerland. Everyone relies on Switzerland, and Switzerland just cut everyone off. Next, the mints. Government mints and private mints that produce silver coins and rounds also depend on Swiss refineries for raw material. The United States Mint buys planchettes, the blank discs stamped into American silver eagles, from suppliers, and those suppliers source their silver from Swiss refineries. If Swiss refineries can't ship silver, planchette suppliers can't produce planchettes. And if planchette suppliers can't deliver, the U.S. Mint can't produce silver eagles. Same for the Royal Canadian Mint, same for the Perth Mint, same for virtually every mint worldwide. The Swiss export freeze doesn't just hit dealers selling bars, it hits mints producing coins. And when mints slow down or stop, when new silver eagles and maples and pandas aren't entering the market, the available supply of recognizable investment-grade silver shrinks even further. And then you've got the industrial users, the companies that actually consume silver in manufacturing: solar panel producers, electronics manufacturers, medical device companies, automotive suppliers, building electric vehicle components. All of these industries use silver, and many source refined silver from Switzerland or from suppliers who source from Switzerland. And these companies operate on just-in-time manufacturing. They don't keep huge stockpiles of raw materials. They order what they need when they need it. So when Swiss shipments don't arrive, when suppliers say, "Sorry, the silver is stuck in customs, we can't deliver for 3 to 4 weeks," those companies face a brutal choice: either halt production and wait, or try to buy silver on the spot market at $150 instead of the $82 they presented. Either option is catastrophic. Halting production costs millions per day in lost revenue. Paying $150 makes their products unprofitable. So industrial users panic. And when they panic, they do what any rational company does. They try to lock in supply immediately. They call every supplier they can find. They offer higher premiums. They try to outbid each other for whatever inventory is still available. And that panic buying pushes physical premiums even higher, which makes the problem worse, which creates even more panic. It's a feedback loop. And it all started at 2 a.m. this morning when Switzerland froze exports. Let me give you a timeline. Let me show you how this unfolds over the next 30 to 60 days, because once you understand the timeline, you understand what actions matter and when. Week 1, which is right now. The Swiss export freeze isn't public yet. The refineries know. Dealers with shipments stuck in customs know. Industrial users who aren't getting deliveries know. But the general public doesn't. The financial media hasn't picked it up. So there's a brief window, maybe 3 to 5 days, where information asymmetry exists. The people who know are already moving. They're locking up alternative supply. They're lifting prices. They're positioning for the shortage. But the average retail buyer, the person who only buys silver occasionally, has no clue. This is the window where being early matters. If you're watching this video right now, if you understand what the Swiss export freeze implies, you have an advantage. You can act before the crowd catches on. Week 2. The story starts leaking. Maybe a trade publication mentions it. Maybe a few dealer sites post notices about delayed deliveries. The financial media still isn't paying attention, but the silver community, the people who actually track this market, starts to sense something is wrong. Premiums creep up. Dealers who still have inventory raise prices. Some products start going out of stock. But it still isn't full-blown panic, yet it's early-stage supply tightness. Week 3. Now the mainstream media notices. Bloomberg runs a piece. Switzerland imposes temporary export controls on silver. Reuters follows global silver supply chain faces disruption. The coverage still downplays the severity. They quote Swiss officials saying it's only a temporary review, that everything will be resolved soon, that there's no reason for concern. But the silver buying public doesn't buy it. They see export controls and supply disruption and they think shortage, so they start buying aggressively. Dealer inventories already thin begin disappearing. Premiums jump from $20 over spot to $40 over spot. Delivery timelines stretch from 2 weeks to 6 weeks. Week 4. Now the Swiss export freeze becomes the dominant story across the precious metals space. Every dealer is talking about it. Every YouTube channel is covering it. Social media fills up with posts about shortages, and the buying panic intensifies. Dealers start imposing purchase limits maximum 5 ounces per customer. Some dealers stop taking orders entirely. We'll resume sales when we can secure new inventory. And premiums go parabolic $60, $80, $100 over whatever the COMEX paper price is. And if COMEX is still frozen, if Goldman and the other banks aren't quoting, there might not even be a meaningful paper price anymore. There may only be the physical price. And that price is $200, $250, $300 an ounce, depending on the product and the dealer. Month 2. Switzerland announces the export license review is being extended indefinitely. Due to ongoing assessment of global market conditions and domestic supply needs, the export review period extends beyond the initial 3-week timeline. Licenses will be granted on a case-by-case basis, prioritizing essential industrial uses. Translation: this freeze isn't ending anytime soon. Switzerland is going to keep silver inside the country until it believes global conditions have stabilized, and global conditions aren't stabilizing. They're getting worse. So the freeze continues and the global supply shortage deepens. Refineries in other countries, smaller operations in the United States, Canada, Australia try to ramp up output to fill the gap. But they don't have the capacity. They don't have the equipment. They can't process the volume Switzerland was handling. So whatever extra they produce is a drop in the bucket compared to what the Swiss supply used to provide. Month 3, the new reality arrives. No Swiss silver is entering the global market. The refineries are still operating. They're still producing refined silver. But all of that production is being allocated to Swiss domestic strategic reserves and to Swiss domestic industrial users. Nothing is being exported, and the rest of the world is on its own. Dealers have no inventory, mints have no planchets, industrial users are rationing silver or shutting lines down. And the price of physical silver, where you can find any at all, is in the $300 to $400 range. Not because of speculation, not because of investment demand, because of real physical scarcity. Because Switzerland, which refines 70% of the world's silver, is no longer supplying the world. That's the timeline. That's the cascade. And it all started at 2 a.m. this morning. Now, some of you are thinking, okay, but other refineries will ramp up, the market will adjust, this is temporary, and maybe over the long term, over years, the market could adjust. But in the short term, over the next 3 to 6 months, there is no adjustment mechanism. You can't build a refinery overnight. You can't train metallurgists in weeks. You can't source specialized equipment quickly. Refining capacity takes years to build. The Swiss hold a 70% market share, not by luck, but because they built that capacity over decades and nobody else has it. So for the foreseeable future, until Switzerland reopens exports or until other countries make massive investments in refining capacity, supply is constrained, the shortage is real, and prices are going to reflect that reality. Let me give you historical context, because export freezes on strategic commodities have happened before. And every time the countries imposing the freeze prioritize domestic interests while the rest of the world pays the price. In 2010, China restricted rare earth exports. China produced about 95% of the world's rare earth elements, and it decided to limit exports to protect domestic supply. The rest of the world, which relies on rare earths for electronics, defense systems, and renewable energy, panicked. Rare earth prices spiked. Some went up 10 times, 20 times, and the shortage lasted for years. The United States and other countries tried to develop alternative sources, but it takes years to bring a rare earth mine online. So, for a long time, China controlled the market, and it used that control to its strategic advantage. In 1973, Arab oil producers implemented an oil embargo against countries that supported Israel. They stopped exporting oil. Global oil supply dropped, prices quadrupled. Gasoline lines formed across the United States. Rationing followed. Economic chaos. The embargo lasted for months, and even after it ended, the oil market was permanently altered. Prices never returned to pre-embargo levels. The shock reset the entire energy market. The Swiss silver export freeze is the same kind of dynamic, a critical commodity, a highly concentrated supply source, a sudden stoppage, and downstream consequences that will be severe and long-lasting. Even if Switzerland reopens exports in 3 months, even if they announce OK crisis over shipments can resume, the damage is already done. Trust is broken. Dealers, mints, and industrial users will all be thinking the same thing. Switzerland did this once. They could do it again. We can't depend on them. And they're going to start looking for alternatives. They'll invest in domestic refining capacity. They'll diversify supply chains, and that takes years. So the market structure is permanently changed. Swiss dominance is over. But the transition to a more diversified refining industry is painful, and we're living through that pain right now. So what do? What's your action plan, given that Switzerland froze exports at 2 a.m. this morning? Let me give you the strategy. First, if you've been thinking about buying physical silver but haven't acted yet, you need to act this week, not next week, not next month, this week. Because this is the window. This is the short period before the general public fully understands how severe the Swiss export freeze is. Right now, dealers still have some inventory. Premiums are high, but product is still available. In 2 weeks, that might not be true. In 3 weeks, it almost certainly won't be true. So if you want physical silver, buy now. Call dealers today. Order online today. Lock in what you can at current prices, because current prices are going to look cheap very soon. Second, expect premiums to explode and accept that reality. Right now, premiums might be $25 to $35 over COMEX spot. That feels high compared to historical norms. But in the context of a global supply freeze, those premiums are headed to $50, $75, $100 or more. So if you're hesitating because premiums feel too high, understand they're only going higher. Pay today's premium. Get the metal, because in a month, the premium might be double and the metal might not be available at any premium. Third, focus on availability, not on getting the best deal. In normal times, you can shop around, compare dealer pricing, wait for sales. These are not normal times. If a dealer has inventory and you want silver, buy from that dealer. Don't wait to see if someone else has it cheaper, because by the time you check, the first dealer could be sold out and then you have nothing. Availability matters more than price. Get the metal while you still can. Fourth, diversify your product selection. Don't fixate on only one product. If you only want Silver Eagles and your dealer is out, but they have Maples, Britannias, or Bars, buy those instead. Any recognized product works. The objective is to stack ounces. The exact product is a distant second. In a real shortage, you take what you can actually get. Fifth, brace for long delivery times and make peace with them. Dealers are going to start pushing lead times out. 2 weeks becomes 4, 4 becomes 8. If you place an order today and the dealer tells you delivery is 6 weeks out, accept it. Place the order. Lock in the price and the quantity. Because 6 weeks from now, that same dealer may have zero inventory and you'll be grateful you got in when you did. Sixth, stay away from paper completely. Do not buy SLV. Do not buy futures. Do not buy anything that isn't physical metal in your possession. The Swiss export freeze hits physical supply. It doesn't automatically reprice the paper market, but paper prices are going to drift further and further from physical reality. If physical is $300 and paper is still $71 because COMEX is frozen, that gap means nothing. You can't turn paper into physical during a shortage. So paper is useless. Only physical matters. Seventh, if you already own physical silver, hold it. Don't sell it. Don't swap it for something else. Just hold. Because what you're holding is about to become one of the rarest industrial commodities on the planet. Switzerland has effectively shut off 70% of global refining capacity. The shortage is going to get worse. And your metal is going to rise dramatically, not because of hype, but because of real supply and demand fundamentals. Let me close with this. 2 a.m. Swiss time this morning. That's when the customs freeze took effect. That's when the Swiss government chose domestic priorities over global supply. And that's when the global physical silver market cracked. The refineries are dark. The shipments are locked up. The supply chain is cut. And anyone who relies on Swiss silver, which is everyone, is about to learn what that dependence costs. Dealers will run dry. Mints will slow or stop. Industrial users will ration or shut lines down. And the price of physical silver will reset to match the new reality. A reality where the main source of refined silver is no longer available. A reality where supply is tight and demand is accelerating. A reality where physical metal is the only asset that matters. The freeze happened at 2:00 a.m. You're hearing about it now. You have a window, hours, maybe days before this becomes mainstream and the panic buying starts. Use that window. Move now. Secure physical silver while you still can, because very soon you won't be able to. The Swiss valve is shut and it isn't reopening anytime soon. This isn't a drill. This isn't fear-mongering. This is a documented customs freeze from the Swiss Federal Customs Administration hitting the 3 largest refineries in the world. The supply shock is here. Position yourself accordingly. The countdown has started and the clock is ticking.